Okay, so the first thing that we should get out of the way is the disclosure. Okay, so as you can see here, it says this presentation is for educational purpose only and is not a recommendation or endorsement of any particular investment or investment strategy. Now, bottom line is this. No matter where you get stock advice from, it doesn't matter if you're watching CNBC, it doesn't matter if you're watching Fox Business, there's always going to be a disclosure. And the reason why is because, for the most part, they don't want to be held legally responsible for you making an investment, especially if it goes sour. A lot of people don't understand the word investment. Basically, investment means that you are using some of your money in order to purchase a stake in something, whether it's a company or a house or property or whatever. And you are doing this investment in order so that you have some share over whatever their future earnings are. So if you buy a house for $5,000 and it appreciates $10,000, now you have a claim to some of that profit that was made or whatever the appreciation is. That's basically what it means. So an investment is a lot like gambling. It can go horribly wrong. You can invest in a company and your money could disappear into thin air. Like, for instance, anybody who bought Bitcoin when it was above $10,000, well, guess what? When Bitcoin dropped to $7,000 and then to $6,000, that means they lost money. It's just that simple. Now, the hope is that Bitcoin rises to 20,000 and that whatever you invested in it earns more money on what you invested. But usually when you're dealing with a society like America that's based in debt and, basically deficit spending, and you have a president like Trump who's writing welfare checks for $1,200 and talking about writing bigger welfare checks for $2,000, well, basically you have to wonder whether or not your future shares will be worth anything, because you always have to wonder whether or not the value of what you're worth is slowly depreciating. And in a lot of ways, America's stock is its dollar. And because of the mindless printing of the Federal Reserve, that stock is reducing in value. So long story short, when you make an investment, it can either go up or it can go down. And if if it goes down, you lose your money. And if it goes up, you make money. But that's the whole point of investing. It's a risk. Usually, the riskiest stocks usually have the highest payouts. That's one of the things about Bitcoin. Bitcoin is extremely risky. However, a lot of people will throw it in your face that Bitcoin has earned more money in a shorter period of time than a commodity like gold or silver. The difference is gold or silver has a more stable value. It doesn't fluctuate thousands of dollars per week. It doesn't go up or down quickly, and it's less volatile. So again, whenever you invest, you're taking a risk with your money, and that's the first thing that you have to understand. So before you can even consider investing any of your money, it's always important to understand that there's going to be a risk involved, and that anybody who gives you advice is going to have a disclaimer. I'm not really giving you, say, demands. I'm telling you what I'm doing with my money. Like if I had told you in 2012, like if I had come to your house and I'd say, hey, listen, let's invest $5,000 in Tesla when it was $30 a share. You might look at me and say, no, I want to take my $5,000 and I want to spend it on crystal meth, or I want to buy some weed, or I want to buy my girlfriend a new kitchen or a spatula or something. You might not have listened to me, and you would have lost out on all that future earnings of Tesla when it went from $30 to $700 or $900 or whatever it is. But, the thing about it is I'm not telling you what to do with your money. You do whatever you want with your money. My thing is I'm just telling you what I'm doing with my money. So that's the only reason why I'm making this video, because I keep getting people constantly asking me, oh, could you please make a video showing us how to invest? I'm like, okay, I'm going to try to make this video to show you a little bit about some basics of investing. Okay, so the first thing I want to get out of the way is that I use the TD Ameritrade Stocks app. You can download it on your phone. You can open an account. I'm pretty sure TD Ameritrade won't mind the fact that I'm using their platform and showing you on their platform. I'm pretty sure they won't mind that. And they have a couple of investment videos. I'll show you where that is again. And the investment videos teach you about how to invest in stocks, how to invest in options, and they basically give you a vocabulary definition of all of the terms that you've probably never heard before. I would also recommend that you watch the movie Wall Street, the movie Trading Places with Eddie Murphy. Very, very good movie. And you also watch possibly Boiler Room and Glengarry Glen Ross. When you watch those films, I think it gives you a really good overview of the psychology of investment and the psychology of brokers. Wolf of Wall Street was really good too. So I would say Wolf of Wall Street, Boiler Room, Glengarry Glen Ross, Wall Street, and the last one would be Trading Places. You could start with Trading Places. I think that was a really, really good movie.
Learning about investing is a lot like learning to ride a bike. At first, it may look intimidating or complicated. Dangers seem to be everywhere. That's why it's important to learn the basics and ways you can help minimize risk and protect yourself. After a good amount of practice and learning, you can take the training wheels off and really start riding. Along the way, the roads may change. There'll be good days and bad days. And while learning to ride doesn't guarantee you a spot in the Tour de France, riding a bike could get you where you want to go a little faster. Let's start with the basics and look at one of the most common investments, stocks. A stock represents partial ownership of a company. When you purchase a stock, you're buying a piece or a share of a company. By owning a share, you own a small fraction of the company's assets and have a claim on its future earnings. There are two ways you can make money by investing in stock. The first is through stock appreciation, when a stock you own goes up in value. If an investor bought the stock at one price and the price went up, the investor could then make money by selling the stock to another investor at the higher price. The second way is through a dividend. This is a periodic payment issued by some stocks. A dividend is a way for a company to give a portion of its earnings to shareholders. Here's an example of how stocks work. Suppose there's a company called Bull Flag Cycling. This company makes bikes, really good bikes. The bikes are so good, in fact, the company wants to expand, so it can sell more bikes to people all around the world. To do this, the company needs to raise money, also known as capital. There are a few ways this company could do this. It could take out a loan, but that would mean taking on a significant amount of debt. Or it could issue shares of stock. By issuing stock, which is called going public, the company can raise money without going into debt. Instead, it sells shares of ownership and a claim on future earnings to investors. So let's meet a typical investor. Our investor is someone who has a little extra cash. He's looking for an investment that has the potential to offer better returns than a savings account, and he is willing to accept the higher risks of investing in a stock. He thinks Bull Flag Cycling is a promising company that's likely to grow. Because of this, he thinks buying a share would be a good investment. So how much does a share cost? Suppose the company decides to raise $1 million, and it decides to issue 1,000 shares of stock. Because each share represents a fraction of the company's worth, and there are 1,000 shares, each share represents 1/1000th of Bull Flag Cycling. Because the company is raising $1 million at the initial public offering, or IPO, each share would be initially valued at $1,000. Let's suppose the price doesn't change after the IPO, so our investor purchases a single share on the open market through his online stockbroker for $1,000. Now, let's see what could happen to his investment. If the company does well and profits increase, the value of the company is likely to go up. As a result, the stock price may increase as well. Assuming the price of the stock goes up, our investor could now turn a profit by selling his shares to another investor in the stock market. However, if the company's ventures don't go as planned, its value could decrease, and so could the stock price. If this happens, our investor could lose money if he decides to sell at the current price. When it comes to investing in the stock market, the basic goal is to buy when prices are low and sell when prices are high. But stocks in the stock market don't always go up. Sometimes they stay the same, and sometimes they go down. And sometimes prices change quickly. Because of this, stocks are considered riskier than other historically safer investments such as bonds or CDs. However, investors keep coming back to the stock market. Why? because with this increased risk comes the potential for greater returns. Savvy investors take precautions to try to minimize risk, like creating an investing plan, adding diversity to their portfolios by investing in a variety of companies, putting money in other investments besides stocks, and learning trading strategies for up, down, and sideways markets. Now you know some of the basics about investing in stocks, but that's just the beginning. You can learn more with our award-winning investing education.
Okay, so if you download the TD Ameritrade app, as you can see, we watched this first video, Investing Basic Stocks, but then they have Investing Basics Options, and then they have asset classes in a portfolio, opportunities and risk, and so forth and so on. Let's say you don't have an MBA. Let's say you've never done any of this before. It's actually quite simple because really this is an income or wealth transfer. What you're doing is you're taking your money and you're investing it into companies that are out there, and you're using your money to help them build their capital, and you're claiming some stake in their future profits or their dividends or both, depending upon who you're investing in. So my whole thing has been investing into companies that pay dividends or that I believe will, appreciate in value pretty quickly. Now, the thing about it is the reason why dividends is such a big deal is because right now the banks are only offering you a very small percent of interest on your savings. So if you have like $100,000 in savings, you're really not going to get much interest off that $100,000. Now, again, investing is risk. So if you invest in stocks, you're taking a risk. Now, if you leave the $100,000 in the bank, there is almost no risk because most likely if you have a good bank, that bank is not going to go out of business. Or if it was going to go out of business, you'd have enough time to withdraw your money so that you'd still have your $100,000. Furthermore, the FDIC insures you up to $250,000. So that means if you have $250,000 in the bank, you have insurance on that money in the bank. Any bank that is FDIC insured, even if that bank was going to go out of business, your money is insured. So there's almost no risk associated with your money as long as it's insured. Problem is your money doesn't grow. The reason why a lot of people invest is because they're trying to make that $250,000 into $1 million or to $250 million. So that's ultimately the gist of it. Now, as you can see here, I've been talking on and on and on and on about airline stocks. Why do I want the airlines? Because the airlines have depreciated in value. The simplest rule about investing in stock is buy low, sell high. So that means what you're looking for is you're looking for stocks in companies that either make a good product or provide a good service that people want. But because of whatever reason, the stock price has reduced, and now you have a chance to start recapitalizing that company. The airlines are absolutely essential. People have to fly. There's no other quick way to get anywhere on the planet than to fly. Boats take way too long, and flying just happens to be the most efficient way of travel. In addition to flying, there's also, shipping by flight. So airlines fly packages back and forth from other countries. So ultimately, the airlines aren't going anywhere. The governments will go deep into debt just to protect the airlines because they need the airlines. That's part of your national defense. That's part of your national interest. It's part of your national economy. The government cannot allow certain sectors of the economy to fall into disrepair. So even with something like coronavirus, the airlines are protected. There's also, in addition to that, there's also some stocks that develop medications such as, vaccines and stuff, or medicine for cancer victims or AIDS patient or whatever it is. But they develop medications or biopharma. That's one way I shorten it. So I set aside a couple of stocks that I know are companies that are trying to develop to fight coronavirus. And as you can see on the left-hand side, you see the symbols for these companies, and you also see the cost per share of these companies. I was talking about Sanofi, which is what, as you know, Trump was trying to get people interested in hydroxychloroquine as a treatment for coronavirus. Now, I told you about this, I guess maybe about a week ago. The days are starting to blend together, so I don't even know half the time what day it is because, I'm chilling in my house with the, stay home order. But anyway, it's slowly appreciating value. As you can see, it was $48.60 per share. It has increased 32 cents. And the problem is, there's a second rule. In addition to buy low, sell high, there's a second rule. Buy on the rumor, sell on the fact. So Trump basically started a rumor that this company was, very successful at making drugs to treat coronavirus. So as you can see, over the last 5 years, they've had a high over $54. And they've also had a low as 30, it looks like $36.80 or so. So the thing about it is, within the last 3 months, because of coronavirus, within the last 3 months, Sanofi has gone from about $38, based on this chart. You can see it's gone from about $38 at its lowest to right now it's at $48.60. That's why $48.60 is highlighted in green. So the question is, well, should you invest your money in Sanofi? The only reason why you would invest your money is if you believe Sanofi has the potential to go higher than it is right now. You would be buying in at $48.60, which means that you have to spend $48.60 of your own money per share in order to hope that that share will appreciate to its highs, which was around $50. But see, that wouldn't make much sense because the high that you see is $56. So unless Sanofi was extremely successful and Sanofi became extremely rich and their share prices went up to $100, you really wouldn't make that much money. So buying high and selling higher is not really as efficient as buying low and selling high. So what else do we have? What else do I have for you? Well, what other company would we be interested in? Maybe oil. Now, as you know, oil has collapsed. And because oil has collapsed, because obviously people are staying home, they're not driving as much, airplanes aren't flying as much, cruise ships aren't moving as much. All of those things take fuel, diesel fuel, jet fuel, so forth and so on. So because of the fact that so many people aren't moving around as much as they were for the last 3 months, oil prices have tanked. On top of that, you also had countries like Iran and Russia who decided that they were going to overproduce oil, and that has basically caused a glut in oil production. So there's so much oil out there that demand has dropped considerably. So oil stocks, for the most part, have reduced in price. So you can always consider one of these companies that has dipped in price instead of the high ones that has dipped in price. Now, as you know from the video, it said there's two ways to make money. You can either buy low and sell the stock once it appreciates in value and gets higher. But the other way is by dividend. So with some of these apps, you have the ability to decide which company you want to buy into based on how much dividend it pays. Dividend yield shows you the percent of the share that you'll get a dividend on. And like where it says X dividend, that tells you about the date, I believe the last time dividends were paid. Different apps show different amounts of information depending upon what you're looking at. But the bottom line is I prefer to buy cheaper stocks once they've been hammered down that pay high dividends. Any of these percentages are far better than you're going to get on a dollar if you put it in the bank. The banks are mostly only paying you 0.05. That's not as much, obviously, as 8.65 or 8.36 in the case of CLB here or WMB. But again, this has to do with how much money you have to spend. Like, for instance, There are two stocks I'm watching for their price to drop that pay dividends here. SLCA and SM right here. SM is 1.62, SLCA is 1.25. If these were to drop below $1, I definitely want to buy into them because SLCA pays a dividend yield of 6.20 and SM pays 1.32. But they're so cheap to buy into that either one over a long period of time is going to earn whatever money I spend in it back if I hold on to it and assume that the company will not go bankrupt. These are oil companies. Oil companies typically don't go bankrupt because they provide oil, which is energy. Energy is the ability to do work. So for the most part, these things don't go under. Then there's things like cruise lines and automakers. As you can see, we have Royal Caribbean and Carnival. Carnival's at $11.84. It's been dropping from $12. RCL, Royal Caribbean, these people right now, their shares are worth $34 because obviously their boats can't move. But now if you look at where they used to be, their 52-week high was $135. So this company is obviously capable of giving you a return on your investment. The problem is right now, coronavirus is kicking the shit out of them. And that has actually made it more affordable for you to consider buying them. So then, what else do I have? Lithium mining stock. There are a couple of companies that I have that mine lithium for electric cars. That's important. So, those stocks are going to grow eventually. But right now, I'm preparing my money for American Airlines, specifically because they're supposed to announce their losses due to coronavirus, and that should drive their share prices down. Now, here's the thing. As soon as they drop below $10, that'll be when I decide to buy in. Now, within the last 3 months, the lowest that they've been was a little under $10. You're talking about $9.38. If you look at them over a 5-year period, their suffering began with coronavirus. They were doing pretty well before coronavirus. But whatever I invest below $10, after coronavirus has been dealt with, I'm pretty sure we'll be back somewhere above $40 or $50, which means that for every $10 or less that I spend, I'll be getting 4 times that. But it will take about a year or two before, coronavirus is completely dealt with, people start to travel again. So this is what we're talking about when we say buy low, sell high. Then, in addition to that, Delta right now is $23. Delta has been a very difficult stock to buy into because it was always so expensive. Over 5 years, the highest that you see Delta is close to $65. And right now, you see this dramatic drop at the very end as you get to the present because of coronavirus. Coronavirus has basically beaten Delta damn near to death. They're not going to go bankrupt because it's a good company. They've got jets, planes, they fly people all over the world. But coronavirus has kicked their asses so much that right now their shares are worth $23. So this is ultimately what you're looking for. Delta pays dividends and they've gotten their asses kicked. And I want to watch and wait for them to announce their earnings this week on the 24th. And after coronavirus has shown us how much they've gotten their asses kicked, you can expect people to sell out of it, which will reduce their shares a little under $20. Again, their shares have already dipped around the second week of March. Their shares dipped, as you can see, below $22. I believe the lowest that they were trading was during this period of time within the last 5 years. So Delta is a strong company which deserves your attention. But again, some people can't afford to take $2,000 and forward it to Delta in order to buy 200 of their shares like I plan on doing. So basically, that's what it is. This is how I do my research. I look for companies that have been temporarily distressed. I buy into them. And then later on, after I've soaked up some of that dividend, I decide whether or not I want to sell or whether I want to keep it. And when I sell it at a profit. And that's basically what you're doing. Okay, so I'm just going to take you through purchasing. So first of all, let's take a look at Apple. Let's say I want to buy into Apple. Apple is $270 a share. That means that you yourself have to have $270 that you're willing to risk on Apple. Apple has had a high of $320, and Apple pays dividends. So if you're interested in buying Apple, now is a tough time to buy it, considering you're talking about $270 per share. However, that's not impossible because some people have a lot of money to waste or to risk or to spend in hope of getting more money back. So that's up to you. I prefer to buy my stocks cheap and wait until they appreciate. Some people are so wealthy and they got millions of dollars and they don't know what to do with it, and they don't mind risking it in a company like Apple and just collecting dividends off of it. To buy a stock, all you need to do is go into your trade app and you hit the button that says trade. When you hit trade, it says, do you want to buy or sell? So I want to buy 1 share of Apple. So what you're looking at is it says the symbol of Apple, $270.25 is its current price. Now in the upper right-hand corner, you see bid and you see ask. What is the bid? What is the ask? The bid right now is $269. That is about the lowest you can possibly get the share for if you ask to buy some of it. The ask is what they're asking you to pay for it. A lot of times, companies won't allow you to buy below the ask. A lot of times you can get away with a bid, but a lot of times they're looking for whatever the ask is. So all you do is you say, I would like to buy 100 shares of Apple because you're rich. You're filthy rich. And when you ask it to buy 100 shares, it says your price per share is $270.22 because that's the ask. You could say, okay, you know what? I want to reduce how much I'm willing to pay for it. Let's say I want to drop it down to 270. Okay, so I've dropped it down to 270. Now, they may accept that. They may not. If they don't accept your bid, because what you're doing is you're bidding and you're saying, okay, I don't want to pay you 270.22, but I'll pay you 270. Maybe they'll accept it. Maybe they won't. A lot of times, if you're close to the ask, they will accept it. But then let's say that you say, well, listen, I want to buy a bunch of shares of it, and now I have some special instructions. So if you hit the special instruction button, you'll see it say, do you want AON, that means all or none. Then you see fix or kill. Now, basically, you'll want to stick with all or none if you're buying a limit type order, as you see right here. A limit type order is basically telling them what you're willing to pay. So if I reduce my price and I'm telling them, listen, I'm willing to pay this much, either you give it all to me or don't give me anything. Well, 2 things can happen. Either they can accept your order and your order goes through, or they don't accept your order and you get nothing and you have to cancel your order and maybe order again. Some people put bids out and they leave those orders sitting, whether or not they get accepted or not. You know, it all depends. Everybody has their own trading strategy, but if you're just a beginner, I mean, you know, right now, beggars can't choose, right? So ultimately, they're asking me at the bottom, the estimated total is $27,000 because, you know, I'm paying $270 per share and I'm buying 100 shares. However, you could reduce this, say, you know, I ain't got that kind of money, so I'm only going to buy 1 share. Well, guess what? The estimated total, $270 because it's only 1 share. You're only willing to pay $270. And that's it. And all you do is hit review order. Your order goes in. And then when the market opens up, the market hours are between 9:30 and 4. When the market opens, they look at your order and they say, oh, you know what? We can do this or not. And that's it. And if you buy that share, now you've got a share of Apple. If Apple increases its value to $320, well, good for you. You've made money. And then you can say, okay, you know what? My Apple is now worth a certain amount. So what I want to do is I want to sell it. So if you want to say I'm willing to sell it, and right now it says this is how much they're willing to, you know, buy it back for, or this is how much your sale is worth, you hit the price of how much you have that you're willing to sell. And then it says what? This is how much you're going to earn if your order is accepted, if they can sell it. And then you sell it, and that's it. You know, a lot of people, when it comes to stocks that have appreciated like Apple, a lot of people got in early and they want to collect those dividends. So they refuse to really sell their stock. Right now, Apple has been considered a sale stock. And the reason why is because the investment speculators don't think that Apple's going to earn that much profit this year because of the fact coronavirus has made it so that people aren't buying as much product. iPhones, for instance, may be delayed for 2 months. They have a new, cheaper iPhone coming out, but obviously they're not going to make as much as if they were having a regular year. Coronavirus has significantly beaten the hell out of a lot of companies. And, that's ultimately what has caused everything to fall down. The fact that the American spender, the American consumer, the Canadian consumer, and consumers all over the world, right now, they're, afraid for their lives and they're hoarding money. However, this market is going to turn around because you got to remember, there's a lot of, how should I say, insurance policies on a lot of people who've just died. There's a lot of people who are going to get paid out from those insurance policies. I'm pretty sure a lot of insurance policies are scared to death of going bankrupt because the problem with them is, if too many people die at once, now you got so many payouts that, that could jeopardize your business. But the bottom line is, once the economy is back to normal, there's going to be a lot more people going to restaurants. There's going to be a lot more people traveling. There's going to be a lot more people spending money. They may not be spending money on frivolous shit like buying cell phones and I don't know, like Toyota Priuses and stuff. But the bottom line is the market's going to come back. And when it does, stocks in general are going to rise. But right now, they're being suppressed by coronavirus keeping you inside, because coronavirus basically tells you, listen, if you go outside, I'm going to get in your lungs and I'm going to kill your ass. And it's just that simple. There's no arguing with a virus. I mean, anything else that has killed 160,000 people would have put you at war with some other country right now. America has lost more than 5 times as many people as it lost in Pearl Harbor or 9/11, and there's nobody to declare war on. So basically, coronavirus is nature's way of saying you're fucked, and I'm going to keep killing you, and I'm going to clear up the skies, I'm going to clear up the water, and I'm going to bury you all, and I'm going to recycle your bodies into dust, and I'm going to prove to you once and for all that I'm in control. That's why nature, you can't argue with it. It has nothing to do with morality. Nature is the perfect thing. It will wipe you out. It will wipe out the stock market. It will bury you. And that's it. And there's nothing you could do except, get buried. That's it. So that is my investment advice. And that is basically how, stock investment works. So if you're interested in purchasing stock, choose your trading platform. It could be E-Trade, Ameritrade, whatever you want to use. I personally would stay away from Bitcoin unless you have a lot of money to risk, because as far as I'm concerned, Bitcoin is extremely risky. Bitcoin is not a good store of value because it's already worth too much for the average person to buy full coins. You can buy fractional amounts of it and hope that it goes up high enough for you to cash out. But Bitcoin is not where you want to store your wealth. If you want to store your wealth, you buy gold or silver. Gold has steadily appreciated over time. Gold has always been worthwhile. Gold has intrinsic value, unlike Bitcoin. Silver has intrinsic value. Silver has medicinal purposes. They use it to make antibacterial materials. So there are certain things where you can store wealth, and then there's certain things where you're risking your money a little bit more than normal. But gold is less of a risk. Silver is less of a risk than Bitcoin. That's what I have to say. So if you have any questions, comments, feel free to leave them. Thank you very much for watching.